Warren Buffett, one of the richest investors in the world, has said that when he dies, most of his money should go into one boring investment. Not individual stocks, not gold, not real estate, an index fund. So, what is an index fund? And why does one of the greatest investors of all time trust it with his wealth? Today, we're breaking down exactly what an index fund is, how it works, and how you can get started with as little as $100. Most people think investing means finding the next big stock, the next Amazon, or timing the market perfectly. But that's not really investing. That's gambling with extra steps. The truth is, the most reliable path to building wealth is almost boring. And it all starts with understanding index funds. An index fund is a single investment that owns tiny pieces of hundreds, sometimes even thousands of companies. The most popular one tracks the S&P 500. That's the 500 largest publicly traded companies in America. So, when you buy one share of an S&P 500 index fund, you're not betting on just one company. You instantly own a small piece of Apple, Microsoft, Amazon, Costco, Visa, and hundreds of other companies, all in one investment. Think of it like this. Instead of trying to pick the one ingredient that makes the best meal, you buy the entire grocery store. If one company has a bad year, it barely matters, because you own hundreds of others. That's the power of diversification. It spreads your risk automatically. Here's the part that surprises most people. Study after study has shown that most professional fund managers fail to beat the S&P 500 over the long run. These are people whose full-time job is picking winning stocks. And yet, over 10, 15, or 20 years, most of them still fall behind. Why? Because consistently outsmarting the market is incredibly difficult, even for experts with teams of analysts. An index fund doesn't try to beat the market. It simply owns the market. It also has very low fees, because there's no manager constantly buying and selling stocks. Over time, it grows alongside the overall economy. And when it comes to investing, boring often beats bold. So, how do you actually get started? First, open a brokerage account. Think of it like a bank account, but for investing. Most brokerages let you open one for free in just a few minutes. And many let you buy fractional shares. That means you can start with as little as $100. Next, search for a low-cost S&P 500 index fund. Buy your shares. Then, do the hardest part. Leave it alone. Keep investing every month, whether it's $50 or $500. Don't try to time the market. Spend time in the market. The biggest mistake new investors make isn't choosing the wrong fund. It's panic selling the first time the market drops. Here's the truth. Market dips are normal. They happen to everyone. And historically, the market has always recovered over the long term. The investors who build real wealth don't run when prices fall. They keep investing. They stay consistent, because long-term success comes from staying in the market, not trying to escape it. Investing doesn't have to be complicated or scary. Open an account, start small, stay consistent, and let time do the heavy lifting. If this video helped you finally understand index funds, hit subscribe. Every week, I simplify one money topic to help you build wealth with confidence. Thanks for watching. See you in the next one.